Good afternoon, everyone, and thank you for joining our call. Today, we'll be discussing how to prepare for retirement planning, and we're also going to be talking about what you need to be doing from an investment perspective. My name is Martin Shields. I'm a wealth manager and certified financial planner at Boucher. So it's great to be here with you to walk you through this and kind of give you some guidance on things you need to be aware of. So we're going to start off with the retirement piece and just kind of walk you through the things that you need to be aware of as you think about retirement. But first, a little humor. So planning is important, unlike this gentleman here who says, I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. So what we're trying to do is prevent you from having this conversation and making sure that you're lined up so that the day that you retire is going to be a fun time and not a stressful time. So let's just go through the basics of 401ks and 403bs so that you know what you need to be aware of when you are putting money in and kind of the amounts you can put in. So for 2020, you can contribute $19,500. That's the maximum amount that you can put in. And if you are 50 and older, you can contribute another $6,500. So that is for a total of $26,000 that you can put in to the 401k, 403b if you're 50 and older. So let's go through the two types of 401k accounts, right? So there's the traditional, which is pre-tax dollars that are going in. Those dollars grow tax deferred, meaning you don't pay any taxes on either the income that's produced from bonds or from dividends and stocks, or any growth in the account until there's a distribution from the account. And that distribution is not a rollover to an IRA, but actually money coming out of either the 401k or an IRA. That's the only time you pay taxes on it. The other option that many plans offer is a Roth 401k or 403b. Those are post-tax dollars that go in, and you don't pay any taxes on either the income or the growth, even when there's a distribution. So the way to view these two options are, if you think you're going to be in a higher tax bracket when you retire, then you're better off putting in those dollars into a Roth 401k or 403b. If it's the opposite, if you think you're going to be in a lower tax bracket when you retire, then you're better off putting those dollars into a traditional 401k or 403b. So the kind of the rule of thumb of this is, if you're early in your career, you're probably better off putting those dollars into a Roth 401k or 403b, right? So putting those post-tax dollars in, letting them grow tax-free all the way into retirement and even for distributions. If you're in the higher element or area of your income for your career, and if you're married and your spouse has a high income as well, then you're probably better off doing the traditional or pre-tax contributions. And in many cases, you maybe would work to split them between the two. So put some money into a traditional and some money into a Roth 401k or 403b. Now, when you leave the company or you retire, those dollars are your dollars. So you can take those dollars and roll them into an IRA. As I mentioned, there's no tax consequence to do this until that money comes out of the IRA in a distribution. And then finally, there are required minimum distributions for traditional IRAs at age 72. It was age 70 and a half, but with the Secure Act that was passed in the end of last year, that got pushed back to age 72. But Roth IRAs do not have a required minimum distribution. So that's another plus for a Roth IRA versus a traditional. So let's go through some of the key things you need to be doing when you're thinking about how to be successful for retirement. First of all, how much do you need to be saving? So a good rule of thumb is you should be saving between 10 to 15% of your gross income. Now, this number is a rule of thumb, so it can vary depending on your situation. If you're in your young 20s and you're starting to save, that number could be actually less. You might not have to be at the 10 to 15% range. If you're in your 40s, mid 40s, and you're just starting, that number could be higher, could be more 15 to 20% of your gross income. But a good rule of thumb to try to get you where you need to be from a retirement planning perspective is to be saving 10 to 15% of your gross income. You really should have a budget. This is one of the most important things that we give guidance on to individuals is having a budget for your household is going to be really helpful to make sure that you're saving enough for things like retirement and also not taking on too much debt. So I would really encourage you to have a budget for your household. And the thing to remember is there's going to be times where you go through that budget, right? That you know that you end up spending more than what you're supposed to. But the fact of the matter is, if you have a budget, you know that that's occurring, right? If you don't have a budget, it's tough to tell exactly how much you should be spending in any different category. So I would really encourage you to have a budget as a household, a monthly budget, and even it doesn't have to be down by the absolute line item, but even high level by different categories. That's going to be very helpful in making sure that you're prepared for retirement. The other thing is having an emergency reserve fund that has 3 to 6 months of your cash flow needs put aside in a bank account, and that money you never touch unless you have an emergency that comes up, a new roof that you weren't expecting, some sort of medical expense, something that you weren't expecting. You use this money to cover that expense, and then you go ahead and you replace that money as soon as you can. And what this does, it makes sure that from a cash flow perspective, you're not getting yourself into a bind, right? Because the fact of the matter is, you're going to be in a situation where you're going to have expenses come up and you need to cover those expenses. And so having this emergency reserve fund is going to be invaluable to prepare you for those situations. The other element that we want to discuss when we'll be spending some time on discussing is how you should be allocated in your portfolio. And quite often we find that people are really nervous about being too aggressive or having too much in stocks in their retirement accounts. And the one thing, hopefully a takeaway with this discussion is that you change your mindset on that, right? You really need to have upwards of 80% or more in stocks, which we define as a growth allocation, to be successful over the long term. Now, if you are within 5 years of retiring, you might want to assess that allocation and reduce your allocation to stocks. But anytime beyond that, you really should have at least 80% in stocks or 90 or 100% in stocks to provide the growth that you need over time. And we're going to go through and kind of get you in that mindset of how to be a good long-term investor, but making sure that you have the right allocation. And because, as I mentioned to you, with many plans we work with, we find out that individuals, even in their 20s or 30s, they tend to only have 50% in stocks, which is definitely not enough to have the growth you need in order to be prepared for retirement. So let's talk about the time frame that you'll have in retirement, right? And this is where many people run into a kind of an issue when they're doing their planning, is that they don't realize how long they're going to be retired for, right? So if you're 65 today, what are the probabilities of you living to certain ages, right? So the purple is women, the gray is men, and the green is the combined couple, right? So if you're 65 today, there's almost a 100% chance that one of you is going to live to be 75 years old. You go out to 80, there's a 90% chance that one of you is going to be living to age 80. And as we go through these numbers, you're going to see that women are definitely have the highest probability of living longer. So if you're the wife in a couple, you got to prepare for you and your husband, but certainly yourself, because you may be the one who's living longer. You go out to age 85, again, 75% chance of one of you living that long. 90, 50% chance, 95. There's still a 20% chance of one of you living to that age. And the thing to remember is with science and technology and the improvements in medical field, that if you're in your 20s or 30s now, these numbers are going to be even more dramatic. Look at this. There's even a 4% chance of one of you living to age 100. So when we plan for retirement, we plan out to age 95. That's the year that we plan out for. And as I mentioned to you, if you're in your 20s or 30s, these numbers are going to look even better of you living to those ages. So you need to plan for that long a period of time. So if you retire when you're 65, that's 30 years of retirement that you need to plan for. Now let's talk about distribution rates from our portfolio, right? Because what's going to happen is when you retire, you're going to have to look at what your cash flow needs are, and then you're going to have to look at what you get from a pension, if you're fortunate enough to have a pension, which many people aren't. And then you're going to have to consider Social Security. And then finally, you're going to have to figure out how much can you take from your portfolio on an annual basis, right? So what this says is, if you have $1 million portfolio and you take certain amounts, how long would that last you, right? So this is with a 40-60 portfolio. So 40% in stocks and 60% in bonds. So a pretty conservative portfolio. Well, what you see is when you start with $1 million, by year 20, if you're taking a 6% distribution with a 40-60 portfolio, you've actually run out of money, right? So you don't make it to that 30 years we discussed. Now, when you move it to a 5% distribution rate on that $1 million, now you got to 26 years, right? So still short of that 30 years that we discussed. And again, this is with a fairly conservative portfolio. But when you move that to 4%, now you're able to increase that to over 30 years, right? So rule of thumb of this is when you're doing your planning, you can assume that you should be able to take about 4% annually from your portfolio. And even with a conservative allocation, that is sustainable for 30 plus years. So from our perspective, when we're doing planning for clients, we're looking at around a 4% annual distribution. That is the ideal situation, because the other thing that we consider, and this analysis does too, is inflation, right? So what we do is we bump up our clients' spending about 3% annually, because inflation is real. It's out there every year. In this analysis, they assume 2.25%, which is also a very reasonable number. But if you're looking at a 4% distribution, that is a very safe distribution that you can assume that you can sustain that for many years. So again, on $1 million portfolio, you're talking about a $40,000 annual distribution that you can spend that money year in, year out, and grow it by 2 to 3% for inflation over time. So now let's kind of flip this analysis a little bit, and let's assume that you have a 4% distribution rate, right? So the amount that we said that we feel comfortable with, you have the $1 million portfolio again. And now let's look at different allocations and see how they do, right? So on this one, you're in 100% cash and you run out of money in 25 years with a 4% distribution. Now, when we put that to a 2080 portfolio, you go to 30 years on that 4% distribution. You go to a 40-60. This was the one that we showed in the previous slide. Again, you have plenty of leeway to go for at least 30 years on a 4% distribution with a 40-60 portfolio. And then finally, if we have a 60-40 portfolio, this is the allocation that we actually prefer for most of our retirees. 60% in stocks, 40% in bonds. That gives you plenty of leeway to have a 4% distribution for 30 years and not be concerned that you're going to be running out of money. So this is a really important guidelines as you're doing your planning as to what your allocation needs to be, and also what is the distribution rate that you can have out of your portfolio and sustain it for many years. One of the things I want to talk about real quickly is annuities, because we are constantly seeing new clients come in and they have annuities. And relatively speaking, we're not fans of annuities, not because of the annuities themselves, but how they're sold, right? That's really where it becomes problematic, is how annuities are sold. So, a lot of times they're kind of pitched as guaranteed investments, and people love that word guaranteed, right? You hear that, it makes you feel good inside. But it's important to understand that if you're getting a guarantee, you're giving up a lot for that guarantee. And that salesperson is not going through and telling you what you're giving up for that guarantee. And that's where that problem is, right? If they're going to explain to you all the pros and cons with what you're doing, then that's one thing. But if they're not going to go through and talk to you about what you're going to have to give up in order to get that guaranteed element. And you may decide, you know what, if that's why I have to give up, I'm not willing to do that. So understanding what the guaranteed investment, what is required to get that. They talk about all the market upside with limited downside. But really, that downside protection also comes with upside limitations, right? You're not going to get that protection on the downside without them configuring in a way that limits the upside. And again, that quite often is not discussed during the sales process. And then really no discussion regarding annuity fees or restrictions. So they're very illiquid, right? Lack of liquidity. Most annuities have a 10-year lockup period that if you want to pull that money out before that, then you're going to have to pay a penalty up to as high as 6 or 7%. We've actually seen now some of these annuities have a 12-year lockup. 12 years, you're going to have to lock up your money. And if you decide to go a different direction, you're out of luck. The annual expense ratios on many of these annuities are anywhere from 1.5% to 2.5%. And the commission that salesperson earns for selling that annuity can be as high as 6%. Right off the bat, they earn 6% for selling you that annuity. So really, you should absolutely not be getting an annuity until you talk to somebody who is very knowledgeable of annuities who's not selling it to you, right? That's really where the important thing is. If you're solely relying upon the salesperson's guidance, then they're going to highlight the real positives and underplay or not even disclose some of the negatives or restrictions on those annuities. So this is really important. I want everybody who's listening to take this away, preach it to your family and friends. It is easy to be sold an annuity. I'm sure these salespeople are very good. They highlight all the positives, but make sure you do your research and you talk to somebody who's knowledgeable, who's not selling you that annuity to give you some guidance on that decision process. Social Security, should you be worried? Right? You got this guy, the boomers there, he's swimming, he's going to jump in the Social Security pool and it's empty. Well, from our perspective, what I would say is as you're looking at Social Security, it is going to be there in some capacity, right? I don't think there's any reality to the fact that, you know, some people saying that Social Security is not going to be there in the future. Now, what I would say is, could it be a little bit different than what you see now? And also, could younger generations be paying more into the system than they are now? And I think both those are could be accurate descriptions of what we are going to see in the future, because the issue we have is when we get to 2030 plus, there's not enough money coming into the Social Security trust system to cover the expenses. So this could be something that we see, but from a planning perspective, you can assume that you're going to have Social Security, but it also is another reason why it's so important to be saving money into a 401k, 403b, some sort of investment vehicle to prepare for retirement to help work with Social Security during your retirement. Those two components for most people is how they're successful during retirement. So again, the real takeaways from this discussion: one, having a plan in place. Cannot stress that enough. If you're a do-it-yourselfer, make sure you have your plan, or if not, you work with an advisor who's a fiduciary. An advisor is a fiduciary. That has to be the case to have a plan. Create a budget for your household. Absolutely important. Save, again, rule of thumb, about 10 to 15%, and having that right allocation, right? Really important to make sure that you're not being too conservative, that you have at least 80% or more in stocks if you're more than 5 years out in retirement. You want to revisit that plan yearly, right? That is very important to look at your plan every year. And then finally, enjoy retirement, all right? That's what we always tell folks. You know, when you're retired, you got to enjoy it because you don't know what the next year holds. And you don't want to be in a situation where, you know, you're in retirement, but you're focused on, you know, what does the next 10 years hold versus, hey, you know what, I'm going to enjoy this time. I've got my plan in place. I feel comfortable with it. And I'm just going to appreciate each day as it comes. So let's talk a little bit about what it means to be a successful long-term investor, because it is difficult to be prepared for retirement if you're not a good long-term investor, right? You can save money, which is the first thing you need to do. You got to save the right amount of money, but you got to be invested properly. And you got to understand what it means to be a good long-term investor. So, you got this sign there, make $1 million in 4 seconds. That's a quick turnaround, and gentlemen saying, like, I have the time, right? I think we're a society that likes things to happen quickly. And that is the real crux of this, right? Which is successful retirement planning it's got to happen. It's got to spend some time on it, but it is a long-term process, right? If you're doing this properly, you should start it in your teen years, right? And then certainly in your 20s. And so you're talking about a 40+ year process. So people are focused on the immediate, but really successful retirement planning is a long-term process and not something that happens overnight. So let's talk about diversification, right? This is so important. And all we mean with this is to be properly diversified, you want to have a lot of different asset classes. And the way to think about this, when I say asset classes, the main ones are stocks. So you're owning companies usually in a diversified fund, whether it be an index fund or an actively managed mutual fund. Bonds, which is when you're lending either a corporation or a government entity money, and they're paying back your principal plus interest. And then finally, cash is the other main category. And then precious metals or commodities is one that's quite frequently talked about. But this first category here, we're looking at a portfolio that it's got some diversification, right? It's got the S&P 500, which is the main equity index. It's got the EFA equity, which is international equities, and the Barclays aggregate, which is a bond index. So it has some diversification over time. The return on this portfolio from a historical perspective is around 6.5%. And the volatility, the movement up or down, is around 12%. Now, as we add in additional asset classes, we add in REITs, real estate investment trust. We add in emerging market equities. We add in some high yield bonds. Now you can look at it. The return actually goes up and the volatility goes down, right? It seems a little bit counterintuitive, but you can actually increase your return and lower the volatility. And what you're doing with this is you're putting in different asset classes that they're not correlated, right? When one's doing not so well, another one is going to be doing better. So uncorrelated asset classes into a portfolio actually increases the return and lowers the volatility, the movements up and down over time. So really, one of the things you want to be doing is having a well-diversified portfolio with a number of different asset classes. Number two is you got to lose this concept of market timing. We see this all the time. People want to be, putting money in, putting money out, trying to time the markets. And, what I will tell you is, unless you got some crystal ball that none of us else have, it is very difficult to do this. And I'll show you with this chart what you are jeopardizing by trying to do that. So if you're fully invested, you just put money in, and this is from 1997 to 2016, and you had $10,000, at the end of that almost 20-year period, you'd have almost $44,000. Your annualized return would be 7.7%. So great return. You've quadrupled your money, more so. You're in a great position, right? Now, if you just missed the 10 best days, think about that. You're talking about 20 years and you're just missing the 10 best days. Now your annualized return is 4%. You've cut your money in half. It's an amazing number. You missed the 20 best days. Now you're less than 2%. You only have $13,000 on that growth out of $10,000 invested. It is, to me, it's stunning when you look at that. As you go down the path, you actually become negative. You actually have negative return if you keep messing these best days. And here's the really important thing to remember. And this is what this says right here in this box, which is quite frequently, these best days come right around some of the worst days, right? 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So what that means is quite often when there's high volatility, like we saw back in March, we see it, people say, you know what, I'm just going to pull my money out. I just want to sit in cash until things settle down. Well, you do that, and when things settle down and they get better, you've already missed it. You've missed the market come back. And this is a perfect example we just saw over the last 4 or 5 months, right? Markets are back to positive for the year. And if you took that approach of like, I'm just going to sit this out until things get better, you really missed out on a huge increase in the market. And that has been shown historically all the time. So trying to time the market is a losing proposition. And I think this is shown in this chart here. So what this chart looks at is different asset classes and the performance for, again, about 1997, 2016. The 60-40 portfolio that's circled there, that is that provides, again, around a 7% annualized return. If you took $100,000 over that 20-year period, you'd have over $400,000 at the end of it, right? So quadruple your money. But now, if you look at the average investor, right? So this is determined by inflows of money coming in and out of retail mutual funds, right? So this is people making decisions as to where to put money. The average investor, retail investor, their annual performance, 2.3%. Huge difference versus if they just put the money in a 60-40 portfolio and let it be versus trying to time the markets, move money around. The average investor performance annualized return, 2.3%. Huge difference. Again, the importance of buy and hold, being a long-term investor and not trying to time the markets. So, market declines, they're going to exist. And what we always say is they're short-term, they're temporary. And what we mean by that is, there could be 3 months like this past one was, or in 2018 when the market was down almost 20%. They can be longer, like it was in 2008 when the market was down over a period of time for, it was about a year and a half that was trending downwards, but they are temporary, right? And that's where people forget. So they look at the red, and these are the declines back over the last 60 to 70 years, and they look at the numbers that they're down and like, wow, that's some big declines, right? In 2007 and 9, the market was down 52%. It was 17 months. And to us, that may seem long-term, right? 17 months. But now when you look at it versus the up markets, they're very short, right? So the greens, the lines that I'm showing here, this is the up markets over that time period. And what you can see is they go on much longer than the downs, and the returns are much greater, right? So this only goes as 2015, and the market was up 178%. It has since been up almost 250%. So that is the important thing to remember. You're going to have down markets. That is going to happen. Absolutely. We always let our prospective clients know, we'll guarantee you're going to lose money if you invest in the market, but it's short term. You're going to lose money in the short term, and over the long term, if you stay invested and you're an educated long-term investor, you're going to benefit by the green lines, right? The up markets are going to way over provide than the down markets take away. One of the things that I want to talk about real quickly is behavioral finance, because it is so important that you have the right mindset, because emotions play such a big role in all of our lives, in every component of our lives, but in particular when we talk about finance and investing. So it's easy to be irrational, right? Here's this gentleman, he's saying, okay, gold is good and bonds are good, so gold bond has to be good, right? It seems like crazy thinking, but I've seen worse. So, let's not be irrational when you're investing. Let's be aware of our emotions and how they impact us. And, we have an investment team that's made up of 5 individuals, and we're human, right? So we have emotions in those discussions. But the only thing is that we're different is we're professionals. So we're aware of what those emotions are, and we try to remove them when we're making decisions with our client portfolios. So some things to remember. Just being aware of your emotions is a first huge step, right? If you're making an investment decision and you're either euphoric because things are really good and you're just wanting to take on more risk, you had an investment that's done really well. I don't know, maybe you're fortunate you bought some Tesla or Bitcoin back in the day and it did really well for you and you're really happy and you decide that you want to throw a whole bunch of more money in there because of how happy you are. Or the flip side is, could be the case. You see things down and the market down and the headlines don't look good, and then you want to sell out. You're acting on emotions and not are you thinking analytically, right? So really being aware of your emotions and not making decisions that are based on emotions. The other element is when it comes to retiring, right? Retiring as we go through the planning for clients, it is such a great time. but it is also a very challenging time as far as some of the changes that you're going to be experiencing. So I really would counsel you to be aware of those changes. And that's where working with a professional can be very helpful because we know what those kind of emotional changes are and we can give guidance. So something to be aware of as you're going through those. You know, the big thing, and we go through this all the time, is fear sells. You have to be aware of how does the media, and these are all the headlines that we've seen in the last 10 years, what does it mean to the actual, for the markets from a long-term investor versus short-term volatility, right? Because it can cause short-term volatility, but from a long-term perspective, this is just over the last 10 years or so, and the market's gone through these times of volatility, and this is true for all of history. So not getting caught up in the headlines, understanding that these media companies, they're out there selling a product and not getting caught up in it. It's just so important really to limit your intake of news and the headlines and not let that impact you as a long-term investor. So what are the things that you need to be aware of to be a good long-term investor? Not being focused on the short term, having that long-term perspective. Really, you can't stress that enough. Not being so biased about what happens more recently. Understanding that, hey, that recency bias can really change your perspective. Making sure that, again, is that long-term trends rather than short-term headlines is what's important. We have a tendency to want to flee things we fear. So when things are bad, our DNA is built to get us out of there. Well, it's really just the opposite. When things are down, that's really when we want to rebalance and buy, right? So when the market was down 30% and you were looking at your 401k statements and really being disappointed, that was the point really where you wanted to be buying and increasing your equity allocation, right? That is a great move to make, is when things are looking really ugly, instead of being only 80% in equity, you be 90% or 100% equity when things are ugly. So getting that mindset that when things are bad, I mean really ugly, you're a long-term investor, hey, go ahead and increase your equity allocation, not decrease it, and just the opposite, right? When things are good, and after 10 years of a bull market like we had, if you want to change your allocation and take some of those gains off the table, not dramatically, but a little bit here and there, that's good. When things are good, you want to rebalance and sell. Again, not in a dramatic fashion, but at least back to a target allocation. That is highly recommended. Well, folks, that's the presentation. Hopefully it was helpful. I think if you can kind of keep these things in mind that we went through, both from a retirement planning perspective and put those in place, and then from an investment perspective, I guarantee you will be successful and have a great retirement. And I'll tell you, there's nothing more enjoyable that I appreciate as an advisor is to work with somebody who's done all the small things all along for many years. And then when they're 65 or whatever age and they're preparing for retirement, it's a lot of fun to do those meetings versus the other situation where they haven't done the planning, they haven't done the small things all along, and then they turn 65, they're looking to retire, and I've got to tell them the bad news that they're not in a good position. So hopefully this is giving you some guidance. Please implement this in your own personal situation. And if you have any questions, reach out to your HR representative, and our firm can have those conversations with you one-on-one if you want. All right, thanks a lot, and take care, folks.